Interest rates in Nigeria's debt instruments, particularly the 12-month Treasury, has dropped to a 10-year low, while the Naira has been devalued twice against the dollar this year, risking losses when the capital is repatriated. With their cash-stranded, funds have few choices but to pack in short-term debt while they wait for the central bank to resume foreign exchange sales that were halted in mid-March after lower oil prices dried up dollar supplies. Well, joining me now to talk more about this is the practice lead Sub-Saharan Research at Dorca Frontier, London, William Atwell. Hello, William. Thank you for joining us. Good afternoon.
Hi. Pleasure.
So we traded in equities on the Nigerian Stock Exchange down 57% in June from a year earlier. It appears investors are increasingly wary of the Nigerian market. What's driving this investor caution?
So there are a number of things. The one really relates exactly to what you mentioned earlier regarding the risk affecting repatriation. Foreign investors very concerned about not being able to repatriate their funds, or of course being exposed to very severe losses if and when we see a currency devaluation. So that's of course reducing their appetite for Nigerian equities and bonds. So certainly a big driver there. Of course, domestic Nigerian investors also have been very cautious, and they, of course, are very close to the woes affecting the Nigerian economy, the real economy, if you like. They're very aware of the fact that the economy has been underperforming for some time and has really been hit by the oil price slump. They're also very aware, of course, that there's been very limited progress on things like economic reform and generally rather pessimistic about the prospects for reform looking ahead. So both on the domestic front and from the perspective of international investors, there's really a lot of skepticism and a lot of caution when it comes to investing in the Nigerian market.
Now, do you see any easing in terms of foreign exchange restrictions in the coming months, which is so clearly top of mind, especially for foreign investors?
So not in the short term. So I wouldn't say in the next few months will we see a drastic more flexibility in terms of foreign exchange availability. Looking ahead to next year, we would, of course, expect a bit more devaluation of the Naira. That's just going to be a necessity, even if the authorities, if it's not indesirable from their perspective. But we would see a bit more devaluation of the Naira as foreign exchange reserves really come under even more pressure as a result of continued low oil prices, and of course, limits in terms of production that we're seeing as well. So foreign exchange reserves being under a lot of pressure, just going to force their devaluation during the course of next year. That could enable a little bit more flexibility in terms of foreign exchange availability. So that'll be a bit of relief for investors, but certainly by no means solving the problem.
Now, looking to the wider region and taking it into consideration the heightened risk environment created by COVID-19, which countries are investors looking to make decent returns, and how are they managing their risk exposure?
Yeah, there certainly has been an increase in terms of interest in emerging markets, given the very, very low interest rates, in some cases, 0% interest rates in many developed markets. There's still a huntful yield, and we expect that to continue through H2 this year and into next year as well, as interest rates stay low in developed markets. So really what investors are looking for is appropriate risk exposure for their investments. We expect interest in emerging markets, but in relatively lower risk emerging markets. So some of the more frontier SSA markets, perhaps less interesting for portfolio investment at the moment, but some of those larger, stabler markets where there's some decent return, Kenya, for instance, Ghana to some extent as well, are potentially quite interesting for financial investors going into 2021 and beyond as well.
All right, thank you very much for your time, William.